We're jumping straight into JD.com today. Everyone is watching the price action, but the real story is the surging user base. I mean, it's now surpassing 700 million annual active customers. That is supercharging their proprietary logistics advantage and really driving a potential re-rating.
Exactly. You're tuned in to the Easy Money Show, where we make sense of the market's biggest moves. We take your information and distill it down to what really matters. I'm glad you're with us.
If you're finding this useful, make sure to subscribe and hit the like button. It really helps the channel. And definitely let us know in the comments which stock you want us to simplify next.
All right, so let's look at the bull and bear case for JD.com right now, I think. If we start with the bull case, the whole argument for growth is really built on this unmatched logistics infrastructure. But we have to start with the financials first, because that's what paid for everything.
Okay, yeah, let's unpack that. We've seen some pretty significant revenue growth, which is honestly impressive given the whole macro environment in China. For Q3 2025, their net revenues hit, what, $42 billion?
42 billion, yeah, about 299 billion RMB. And that's a year-over-year increase of almost 15%.
And 15% is solid.
It is, but you can't forget what happened just before that. Q2 revenue growth it soared to over 22% year-over-year.
Right, that was the highest growth rate they'd had in 3 years.
In 3 years. So that tells you the acceleration was very, very real. It was driven by, electronics and appliances, but general merchandise saw a good jump too, over 16%.
So it's not just a flash in the pan. There's a trend here. But this is where it gets really interesting for the long term. The customer story. I mean, if you're looking at this, you have to focus on engagement, not just revenue. Annual active customers are now over 700 million.
Huge number.
But the metric that really jumped out at me was the quarterly active customers. They're up over 40% year over year.
That 40% jump is the key metric. It really is. That separates this from just, expanding their reach.
It's about frequency.
It's frequency. When it rises that sharply for 2 quarters in a row, it tells you the whole ecosystem is working. They're using their strengths, like that fast delivery, to push things like groceries.
High frequency stuff.
Exactly. That drives repeat business, and repeat business is so much more valuable than just going out and finding a new customer.
And what lets them acquire and, more importantly, retain those 700 million users?
Yeah.
It's their financial health. JD.com has a really strong balance sheet, and they're generating robust free cash flow. And that FCF, it's not just a line item on a report, it's their war chest.
That's right. That free cash flow lets them do 2 critical things at once. First, keep shareholders happy with buybacks and dividends. And second, they can keep plowing money into those key growth areas. We're talking cloud, we're talking AI, and of course their global logistics expansion. It's what keeps that moat so deep.
Okay, so speaking of the moat, let's define what that really means for JD.com. It's not just that they're big, it's this whole vertically integrated model. Can you explain why that's so different from just a pure marketplace?
Sure. I mean, unlike their rivals who are just, providing a platform to connect sellers and buyers, which opens you up to all sorts of quality control issues, JD.com owns the whole thing, end to end. Proprietary logistics, direct procurement, and really strict quality control on everything.
And for the actual consumer, in a market like China where, trust and reliability are everything, what does that control mean for them?
It means superior fulfillment. It's better inventory management. For you, the customer, it means faster delivery, reliable quality, and maybe the most important thing, a much lower risk of getting a counterfeit product.
Right.
That reliability is why 700 million people stick with them, even if a competitor might be, a tiny bit cheaper sometimes. They're retaining users by focusing on quality.
So it's a very clear strategic choice. They're not trying to be the absolute cheapest on everything.
No, and they're segmenting the market. I mean, they're not ignoring the growth in China's lower-tier cities. They use Jingxi, their other platform, to target those areas.
Which is smart.
It's very smart. It lets them capture that emerging consumer base without sort of diluting the premium feel of the main JD.com brand, which is all about quality and speed.
So if logistics built the moat, technology is building the future. It's not just trucks and warehouses anymore. It's about how AI makes all of that smarter.
The partnership with Huawei really caught my eye here.
Oh, that collaboration is incredibly significant. It's focused on using AI for advertising and, this is the important part, low latency inference.
Okay. For those of us who don't speak Silicon Valley, what is low latency inference?
It just means the AI system can make decisions in real time incredibly quickly.
Yeah.
It's not just about showing you an ad faster. It's about optimizing their entire network. on the fly.
So if I'm reading that right, this is less about making more money on a retail sale
Right.
and more about expanding into these higher margin service segments. They're using their physical network as a platform to sell data and advertising services. Precisely. They're monetizing their user data and their logistics network at the same time. The AI partnership is all about growing that service business faster than the competition can.
And now we're taking this model global. You see the Joy Express service and that really high-profile investment in the Riyadh warehouse.
The Riyadh investment is so strategic, it's not just a warehouse. It lines up perfectly with Saudi Vision 2030.
Ah, okay.
When you align with a sovereign strategy like that, it secures long-term support. They're exporting their expertise to these high-growth regions.
Okay, so that's a very robust bull case. You have user momentum, financial discipline, this massive logistics advantage, and now a future built on tech and global expansion.
Sure.
But the market isn't fully rewarding them yet, which suggests the risks here are pretty heavy. Let's pivot to that bear case.
The primary risk right now is it's tied directly to the macroeconomic environment in China. I mean, consumer confidence is taking a hit, and you see it in their core categories.
Like appliances.
Exactly. Electronics and home appliances were huge growth drivers. But recent data from October and November of 2025, it showed declines of 15 to 19% year over year in those areas.
Wow, that's a serious headwind. I mean, durable goods like a fridge. That's one of the first things people put off buying when money gets tight.
It absolutely is. And the second point here is margin compression. We saw in Q3 that margins were a bit thinner than expected. Now, this wasn't really because of bad performance. It was because they had to make these investments in new businesses.
So the stuff we were just praising, the Jinxie expansion, the overseas logistics, the market is punishing them for it in the short term.
It's the classic dilemma, right? Do you want growth tomorrow or profits today? The market sees the investment and it hits the near-term numbers.
And you still have the competition. PDD is a fierce rival on price, and Alibaba is still the behemoth on scale.
And on top of all that, you just have the general regulatory and geopolitical caution around all Chinese tech companies. The market is just cautious by default.
Which brings us to valuation. If the risks are so clear, why isn't the stock even lower? It seems like a lot of this is already priced in. It's trading around $29 a share, and some analysis suggests it's actually undervalued based on cash flow and assets.
The market sees the strong underlying asset, that moat, but it's waiting for proof. It needs to see that the operational efficiencies from AI and cost controls can actually overcome these macro pressures.
Right. It wants to see that margin compression from Q3 reverse.
Until that proof shows up, the stock is kind of stuck in this holding pattern.
Though technically the charts look a little more constructive, it seems to be in what analysts call an accumulation phase.
Which, to translate that, just means that after hitting its lows in the autumn, the stock has started making higher lows. It suggests money is flowing back in, slowly.
Buyers are seeing this as a decent long-term entry point.
Exactly, even with the mixed news.
But the institutional flow, that gives us a bit of a mixed signal. We saw a pretty big exit. XY Capital sold off over 400,000 shares back in November.
Right, so some of the big money is deaccumulating, maybe because of those exact macro concerns we just talked about.
So for you, the person listening and trying to time this, let's look at the calendar. What are the key events coming up in the next 3 months?
First and foremost, you have the Q4 2025 earnings report that's coming in early February 2026. This is the big one.
And the market won't just be looking at the top-line revenue.
Yeah.
We kind of already expect retail to be a bit soft because of that October and November data.
No, the real test will be the service margins.
Exactly. Is the AI integration, is the logistics optimization, is it expanding those high-margin revenues from advertising and cloud? We need to see that efficiency hit the bottom line.
Beyond earnings, you have to watch for follow-up announcements. Are there new details on the Huawei AI partnership? Is there another international move? Every milestone helps validate that long-term story.
And you can't rule out macro tailwinds. The whole China e-commerce sector could see a recovery if there's stimulus or rate cuts.
Or just a simple sector rotation back into quality large-cap names like JD.com.
And there's one more thing, a speculative one. There was this unconfirmed rumor about testing a $500 million AI supply chain listing in Hong Kong.
Yeah, that's one to watch. If that turns out to be real, it would be a major positive catalyst.
It wouldn't just be about the money. It would accelerate the monetization of their tech, and it would validate that whole tech moat in a very public, quantifiable way that could dramatically re-rate the stock.
So the debate is really, Is JD.com a value stock facing a cyclical downturn, or is it a long-term growth story just hidden by some macro fog right now?
So what does this all mean for you, the person interested in JD.com? It seems like the market gets the strength of the user base in the logistics mode, but it's waiting. It's waiting for confirmation that all those efficiencies can overcome the near-term pressures, like those softening appliance sales. The strength is there, but you'll need patience.
Exactly. The multi-year potential is still high if they execute on the global and technology strategies. They have the money. They have the users. Now it's about proving the scalability of those high-margin services. The whole thesis really hinges on tech expanding margins, even if retail is soft for a bit.
That's the lowdown on JD.com for today. If you haven't already, subscribe so you don't miss our next breakdown. We'll catch you on the next one.
Farewell.